Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 13th, 2024. How you doing? Hope you're doing well. I appreciate you coming to my weekend review podcast. I hope you had a good trading week. Boy, it was a volatile week, really was, especially on Friday, but we're going to break everything down. I'll give you my thoughts. And the format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly time frames. We're going to talk about when I entered the trade. We're going to talk about why I entered the trade, what the setup was, what the thinking was of why I entered the trade, what were the confluences and the combinations of indicators that led me to take that trade, and what strategy that I was using on that particular trade. And then most importantly, I'm going to explain how I am going to manage the trade going forward. It's very important to have a plan and to know exactly what you're going to do regardless of what your position does. Know what to do if it moves up, uh, know what to do when it moves down, when to get out, where your levels are at. It's very important to have a process of when, why, how, if-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. It all comes down to risk to reward ratio. You're not always going to be right. I'm wrong all the time. But proper trading will teach you, and if you're trading properly, if you're wrong, you should cut your losses quickly. If you're right, you should have a plan that lets you stay in the trade so that you can have some big outsized gains. And that's the math in trading. Good setups, good confluences of indicators or triggers happening, position sizing correctly for the volatility of the market, and your equity size in your trading account, and then having a very good risk to reward. So if you're wrong, you can be wrong small, and if you're right, you can be right big. That's really what it's about. You're going to have many losing trades, and if you keep them small, then just a couple of big trades will help cover those losses and have a profit as well. So that's really what trading is about. So we'll talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage these trades going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to follow your plan, and that comes down to psychology. So it's always helpful for me, myself, to teach these concepts, and I hope that it is helpful for you and that something I say one day will click with you and that it will improve your trading. After that, I have gone down through my master watch list last night, both on the daily and the weekly time frames, and I will share with you the trades that I am looking for next week, what the confluences are, what I'm looking for, big picture. And those particular trades are not where they need to be yet, but if they come to those areas, then I will consider taking the trade. If they don't come to those areas, I'll just move on to a market that does. It's important to be patient and wait for the market that you're looking at to come to a good spot where a confluence and combination of indicators or supports, moving averages, V1s, V2s, line up. It will improve your chances of having a winning trade. So I will share with you what I am looking for at that moment, both on the daily and weekly time frames. And I do feel like I have some really good ones next week. Not a lot, but I do have some really good potentials that I'll share with you. And then after that, I'll talk a little bit about the market in general. We'll look at some of the indexes. We'll look at the bond market. We'll look at VIX. VIX has spiked up recently because of many factors. There's a lot of things going on there. The tensions in the Middle East, interest rates going up. So a lot happening, and VIX has increased because volatility has come into the market. So I'll share my thoughts with you on the market, the overall market as well. So I hope this is going to be helpful for you. If I say anything during the podcast that is valuable to you, I really would appreciate it if you could hit the thumbs up button. It does really help build the channel and helps YouTube know that there's some valuable content here so they can get out and share it with more people. So I would really appreciate that. So, okay, let's get started. Let's run that let's get started by running the U.S. legal disclaimer, and then we'll get into the content. All right, so hang tight for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get into it. Let's start with my only open daily position, and it is a short position on PayPal. So you can see this highlighted blue area in here. This is what's called a fair value gap. In order for a fair value gap to occur, you need to have a high followed by another high. When that happens, if you get a strong break that takes out the first swing low, what this does is it changes the market structure from positive to negative. And if you go from a positive structure to a bearish structure, then you, at least I, attempt to short rallies. When you go from a bearish structure to a bullish structure, you should look to buy dips, but this is different. High, higher high, this bar takes out that swing low. This now changes the market structure to the downside, and the very next bar here, bar number 3, creates what is called a fair value gap. And the fair value gap is this range here. The low of bar 1 to the high of bar 3 is what is called the fair value gap. And you can see, as often happens, we rally back into this fair value gap, and this comes from ICT. You can look this up on YouTube, but it's very, very good approach to trading, and I've incorporated it into my trading over the past 6 months, and very, very helpful. And by the way, I do teach private one-on-one lessons in the evening time via Skype. It's a great course. I used to teach 5 trading approaches, but over the past 6 months, I've actually included the fair value gaps, order blocks, and so forth as well into my trading lessons. So 7 different ones. I'll talk more about it near the end of the podcast. But if you are interested in learning from me, I do teach a 15-hour course, 5 sessions, 3 hours per session. That's where you get the 15, and I teach you step by step all the trading approaches that I use. Think about it. It's a great course, and you're going to be a much better trader. So anyway, I've highlighted this blue area here again because of high, higher high. This big bar takes out this low, turning it into a bearish market structure. Anywhere in this green area, this blue area in here is the shortable area, with my stop being close over this high, because if we came back and we closed over again, that would change the market structure back to bullish. So I did get short here at 66.44 on the 8th of April, and currently we are at 64.59. So far this particular trade is in the money, 2.91%. So when I take a trade, there's always an offensive and defensive part to a trade. The defensive part are your stops. I always have a end of day stop, and I also have an emergency stop. The end of day stop, I wait for the end of the day. If, like I mentioned a little while ago, if it closed above this high here, I would exit the trade. But I always have an emergency stop, which is exactly 2 ATRs above my entry. That's my maximum allowed loss, and I don't wait for the end of the day to take that. And if I get there, I'm simply out. I've lost 1% of my account. The good news, this only happens about 5% of the time. 95% of the time, if you do have a loss, it's going to be your end of day loss 95% of the time, but 5% maximum. So this is the defensive area of my trading. The other defensive part of my trading is once I enter, this is a short position, I place a 1.5 ATR trailing stop level 1.5 below my entry. If it was a long position, it would be 1.5 ATRs above. But since this is a short position, if it does reach my trailing stop level, it's not there yet, 63.60. If it does get to that level, then it means I'm in trailing stop mode, which, because I'm short in this position, if I then in the future get a close above a previous bar's high, then I would exit half of my position. If I'm long and it goes up 1.5 ATRs, then if I get a close below a previous bar's low, then I exit half. This is also defensive, but I also play offense on the trade, and offense means that if the market goes my way, in the direction, this is short, so short, if the market goes my way by the value of 0.45 ATRs, today it's 78 cents, then I take 10% of my position off. And I always place 3 limit orders every single day. I have to redo them every night, and that's the offensive part. So if it moves, for example, on Monday, if it moves the value of 0.78 less the closing price, then I will take off 10%. If it moves double that, I'll take off another 10%. If it moves triple that, I'll take off another 10%. So that's the offensive part. The defensive part of your stops, your trailing stops, the offensive part of trading is taking a partial profit, not all, of the position, which reduces your position size, locks in profits, and reduces your overall risk on the trade because you're reducing your position size. So when I got long here at 66.44, the next day, of course, it moved against me, so there were no profit targets. But the next day, I hit 2 profits to the downside, took 20% of the remaining shares off, reduced my position size, locked those profits in. The next day, hit another profit target to the downside, and then on Friday, hit another profit target to the downside as well. So I keep reducing my position size, playing offense. So the stops, the trailing stops, defensive, the taking partial profits when you have them, offensive. And you know, there's a big psychological component to taking these off. I was speaking with a student of mine, Andy, last week, and we were talking about his trading, and we were talking about, as he was taking off these partial profits, how it reduces stress and kind of makes you feel better about the trade. And the most important part about that is, as I mentioned at the beginning of the show, you have to follow your process. Well, taking off partial profits and reducing your position size as the market goes your way is a great way to take pressure off, and it's a great way to help that you're going to follow your process more. Does that make sense? So it's very important to me to play offensive as well, for many reasons, but a very important reason is that it takes pressure off and helps you follow your process. And to be successful in trading, you have to follow your process. So anything that you can do to help follow that process more exactly is very, very important. And that's why taking these partial profits is extremely important. So again, this particular short on PayPal PYPL up 2.91%. And next week, if we go down and visit this level here, 63.60, then I will go into trailing stop mode, which means I'm going to be more defensive. And if I have a close above a previous bar's high, then I will take half of the remaining shares off as well. All right, so this one up 2.91%. And that's my only open daily position at the moment. Let's go to the closed positions. Okay, Intel. I did buy Intel here on the 9th of April at 37.95. Why did I do this? This was an excellent trade setup. It did not work, but this was a triple A rated signal. Why? Because we had multiple confluences of signals. Here's the 250-day moving average on Intel, the purple line. This went under the 250 and over the 250 during the day. That by itself is a legitimate signal based upon my deep dip buy stock trading strategy. That's one. Number two is that we went under the 30 RSI and over the 30 RSI. That is a legitimate signal by itself. But that, the under 30, over 30, at the same time we reject the 250-day moving average, makes the trade even better. Number three, we had a V1 entry trigger. Bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. This is about as good as a deep dip buy signal as you can get. But it didn't work out. And this is a good lesson. No matter how strong the signal is, it may not work out. So let's analyze the trade here. I position size based upon the current market volatility and my trading account value. My end of day stop is simply a close below the 250-day moving average, giving me a good risk to reward ratio. My emergency stop is down here, 2 ATRs. In case it gets down there, I lose 1%. The next day, it closed below the 250-day moving average. I got out for a loss of 1.96%. Okay, it happens. Little surprising, you know, when the signal is that good. I was fully expecting this to be stronger, but we had that CPI number that came out that rocked the market down and unfortunately turned into a loss. But it was a small loss, right? It's 1.96%, not of my account. If it got down to my 2 ATR emergency stop, it'd be 1%. So, you know, it was like not even a quarter, 3/8 of a percent, right? But the more important thing is that look what happened now. Up a little the next day, and then down 5.16% again on Friday. So it ended up being a loss, but when this good of a entry signal fails, the market's kind of telling you something. So obviously it was good that I just got out, took my loss, licked my wounds, and got on. Imagine if I would have just said, I think it's low enough, and I don't think, I think it'll go up, so I'll just hold it. I'll ignore my signal. If I'd have done that, would have been another whopping 5.16%. So this was a loss, but the important thing is that you're going to take many losses. The important thing is you know where your stop was. I knew exactly where my stop was. It was a good risk to reward ratio. This one just didn't work out, so a loss of 1.96%. Rio. All right, Rio was a great trade for me. Rio, I entered all the way back here on the 29th of February. Why? Well, you can see I have a highlighted blue area here. This is, you can see the bar to the left, the bar to the right. You can see how this little box is hanging out in space. This is called an abandoned baby. We gapped down, so for whatever reason overnight the news was very bad, or the sentiment was very bad. The very next day, however, it gapped up. It went from being bad to good from one day to the next. That's telling you something. This is called an abandoned baby. An abandoned baby is when you include one bar. An island reversal is when the same thing happens, but it's more than one bar. And if you'd like to learn more about these, this is one of my favorite new trading approaches. And again, this is what I do teach. This is in my private one-on-one lessons. But go to my YouTube channel, look up island reversals and abandoned babies and why they're one of my favorite new approaches. They don't always work. I have a trade later that I'm going to show you that didn't work, but they're great setups in my opinion. And so on this particular trade, when this happened, I got long here 61.78. Now on abandoned babies and island reversals, I don't use the scaling out method. I like to diversify my exits, and I have found that abandoned babies and island reversals are some of the best trades to do this on. What I do is I place a stop 2 ATRs below, so that if I'm wrong, I'll lose 1% of my count. And then I place a profit target 4 ATRs above, so I have the proper asymmetrical risk to reward ratio. If I'm wrong, I'm losing 1%. If I'm right, I'm making 2%. And they may confuse you because I said 2 and 4. Well, a 2 ATR stop and a 4 ATR gain would equate into a 1% loss or total account loss, or a 2% gain. And so that's what you need to do in trading. You need to have a setup where the chances are more likely that it's going to go your way. They're not always going to go your way, but they're more likely to go your way. And that if they do go your way, you're going to make more money than if you lost. Let me give you an example, and I think you'd be able to relate with this because it's exactly the same thing. Let's say you were playing heads or tails with a quarter with a friend of yours. Well, heads or tails is 50-50 proposition, right? But let's just say it was a special coin where 70% of the time heads came up, 30% of the time tails came up. And every time heads came up, you won $2, but if tails came up, you lost $1. Would you play that game? Of course, as long as you could stay awake, because 70% of the time you are going to win, right? If heads comes up 70% of the time and tails comes up 30% of the time, you're going to win. But let's say that when you win, you're going to get paid $2, and if you lose, you're going to lose $1. Well, of course, you are going to take that trade. Or you're going to play that game as long as you can, because of course you're going to win. Your heads is going to come up more often than tails, and when heads come up, you're going to get paid more than if it was tails. Well, this is exactly the same scenario with trading. In my opinion, these abandoned babies and island reversals win about 70% of the time. And when they win, you make more than when you lose. And this is a perfect example. If I lose 2 ATRs or 1%. If I win, I make 4 ATRs or 2%. Well, I got long here, 61.78. Here's my 2 ATR stop. Here's my 4 ATR gain. It was really, really choppy all the way around here, roller coaster ride. And then here on the 9th of April, look at that, hits my profit target for a gain of 8.31%. So I hope that heads or tails analogy was helpful for you, but it overlays perfectly when I use these abandoned babies and these island reversals. And this was a huge gain, 8.31%. And you can see I hit it, immediately went down. Friday, up big. I was like, oh, it's got more juice in it. And then it had this big reversal. But anyway, I hope that was a good explanation and helpful for you. Really what trading is about. Find a strategy that wins more than it loses. And when it wins, it makes more money than it loses. It's the best of both worlds. So gain of 8.31%. Okay, we just talked about abandoned babies. Let's talk about an island reversal. Okay, island reversal. I took an island reversal here on the 4th. Why? Island reversal, again, consists of 2 bars. Gap down, sideways motion, gap up. That was my entry signal. Why? Gap down, immediate gap up. Same thing. 2 ATR loss to the downside, 4 ATR gain to the upside. Not going to win all the time. This one did not win, but the important part is that when I lost, I only lost 1% compared to making 2%. So my 2 ATR stop was down here on the 10th. It did trigger, and I did lose 1% on that position. But more importantly, on the Rio trade, I made 2%. So there you go, right? You're not going to win every single one. So Just a recap on the dailies, open and close. Daily, my current position on PayPal, PYPL, currently short and currently open at 2.9, a gain of 2.91%. The closed positions, Intel, loss of 1.96%, Rio, a gain of 8.31%, and TLT, a loss of 2.12%. So they're not always going to be gains, right? Not always going to be winners. I never even think like that. I just know at the end of the day that my winners most likely are going to be larger than my losers. Even if I was 50% of my trades won and 50% loss, that's fine. Just as long as your winners make more than your losers. And, here on the trades that I showed you, that is the case. So those are the dailies. Let's talk about the weekly trades. Weekly trades I take on a Friday because that's the end of the weekly bar. And I cannot tell you how happy I am that I got stopped out of this trade today, for my sake and for your sake as well. I laugh about this, but it's true. I have been in this trade for over a year, and every week I talk about this trade, and I'm sure you're tired of it. I'm tired of it, but it's a very good example of following a process and not getting out emotionally or I can't think of the word right now, impulsively, of following your process. This was a huge, huge gain, and I would have been able to have this gain if I didn't have a legitimate trading process in place to tell me what to do. If it's just up to me, one day I'm going to be emotional or impulsive. So let's start off here on XLF. I bought this all the way back on the 24th of March. Why? Well, this is a deep dip buy strategy. Here we have this purple line is the 250-week moving average. These are major levels: the 200-week moving average, the 250, the 300-day week moving average, the 30 RSI. These are all deep dip buy approaches. And in this particular one, this was back 324.23. During the week, we went slightly under the 250 and then closed above the 250. This is called an intra-week rejection of the 250-week moving average. So I entered here $30.71. I position size according to the volatility of the market and my account size. I placed my emergency stop always 2 ATRs below. My end of week stop is simply a close below the 250 week, right? So if I'm wrong small. Then when I enter, I place my 1.5 ATR trailing stop level above because this is a bullish trade, long trade. And as always, if it moves the value of 0.45 ATRs from the previous bar's close, I get out of 10%. Well, the next week immediately went up. I took some profits. Next week, sideways motion. Next week, went up again, took some more profits off, and I got to trailing stop level. And all this means is that now I'm in trailing stop mode. And what that means is that now in the future, if I have a close below a previous bar's low, I'm going to get out of half the position. So we just kind of moved sideways here, slightly down, but we never closed below a previous bar's low, sideways, sideways, sideways for about a month and a half. Then we started to move up, then we started to move up, then we started to move up. And then this was our first close below a previous bar's low. After reaching trailing stop level, I got out of half of my position for a gain of 6.26%. Then we moved up for over a month, took some profits, hit a profit target, right? Keep reducing my position size. Then we moved down strongly. I did have a couple profit targets in here on some rallies, but then we moved down strongly. And this bar is very key here on the 27th of October because during the week, we again closed below the 250-week moving average. Had this closed below, that would have been my signal to get out of the trade, and it still would have been profitable at that level. But it did recover, and it's closed slightly over the 250-week moving average, so I kept the trade. Thankfully, again, my process told me. If it was just up to me, I probably would have gone, oh, this looks horrible, I'm bailing, right? And thankfully, I didn't, because the next week, huge move up. I think I hit 3 profit targets on that particular week. Next bar sideways motion, another week up, took more profits. Then another week up, not enough to take profits. Another nice week, took some profits, no profits here, huge week. And then we just started to drip higher. We went higher and higher and higher. Did take a profit here, did take a profit here, but then we started to just move up, move up, move up. Did take a profit here. And at this point, once I get to a 65 RSI level, right now the RSI is 61.74, but once I get to a 65 RSI level, my 5 EMA comes into play. That is my trailing stop mode. What that means is that if I have a close below that 5 EMA, I'm out of the trade. Other signals that tell me to get out of these trades are if we reject the 70 RSI, and then I would sell half, and then if I have a close below previous bar's low after rejecting the 70 RSI, I get out. But I'm telling you this because no matter, I know exactly what to do regardless of what the market's doing. And when you get up to the 65, 70 RSI levels, that's generally the time you're probably going to start taking profits. But you can see for weeks and weeks and weeks, we kept holding this 5 EMA. Last week, we went below it interweek, but then it recovered, kept me in the trade. And then this week, it definitively closed below the 5 EMA. That's it. I'm out of the trade. The remaining shares on that particular trade, 23.23%. Massive trade. Glad to be out of that. Glad I'm not talking about this anymore again for my sake and your sake. But this trade is a great example of a good trading principle of if you're wrong, being wrong quickly. If you're right, staying in and being patient with the trade as long as your process tells you to stay in. You've got to find a process in your trading, whether you learn it from me or someone else, it doesn't matter, but you have to find a good process that gets you out quickly when you're wrong and gives you rule-based reasons to stay in if you're right. And that's all those rules there is what kept me in this trade. So this finally closed out for a gain of 23.23%. Really, really good trade. And I'm glad I'm out of it. CCJ, another weekly trade. Okay, this is a perfect example of a different trading approach that I use and I teach called a return to value V2. Love this. I really love these approaches because they make so much sense. Take a look at the two green bars here. This is the top green and the bottom green. Anywhere in here is what is called the value zone. As a general rule, I like to buy in value and sell above value. I like to buy below value or sell in value. What I don't want to do, you do what you want, but for me, in my 28 years of trading experience, buying over value just is not a good idea, right? If you're buying a car, you're buying groceries, buying anything else, buying over value is generally not a good idea. You want it at value at the very least or under value. You know, stocks are about the only thing that people don't want to buy on sell. Everything else they want to buy on sell. But stocks, for some reason, people want to pay full price or higher. Well, it's very simple for me. The top of the green line, I generally don't buy over value. I wait for it to come back to value. You can see clearly we're above value here. We came back into the value zone. So this particular approach, and if you'd like to learn more about it, go to my YouTube channel. I have a free video there on return to value V1s, V2s. I hope it's helpful for you, and if it is, give it a thumbs up. But you can see the price closes above the green line, closes above the value zone, comes into the value zone. So I should say, the first requirement, you close above the value zone. Second requirement, you come into the value zone. Third requirement, you need sideways motion. You need to see that there's some buyers that are showing up and you're getting an equilibrium of buyers and sellers. That's what causes sideways motion. So above value, into value, sideways motion. Now I'm ready to take a trade, but I need a signal. And the signal that I use on these particular trades is called a V1 or a V2. And I have a YouTube video that you can look at about V1s and V2s. Just look it up on my channel. I think it'll be very helpful, and V1s, V2s are a big part of my trading. This is a V2. A V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 has to go below bar 1's low. Bar 3 has to close above bar 1's close. See how it forms this little V here? That is the signal. So this is a perfect signal. We're above the value zone, we come into the value zone, we have sideways motion, then we have a V2 entry trigger. I got long here on the 22nd of March at 42.80. Okay, as soon as I get long, what do? I have to place my emergency stop 2 ATRs below. And then on a V1 or a V2, my end of day stop is simply a close below halfway of the washout bar, in this case, bar number 2. And I've highlighted this here at 40.80. All that means is after I take the trade, I got in at 42.80. If it in the future closes below halfway, that's my end of day stop. That's my line in the sand. I just get out there. Of course, if it gets my emergency 2 ATR emergency stop, then I get out there as well, right? But that only happens 5% of the time. In this particular setup, 95% of the time, if you're wrong, it's simply going to be a close below halfway of this washout bar, which is a good risk to reward ratio. But luckily, went my way here, entered 42.80. The next week, it didn't do much, not enough for a profit target, but the next week took off massively, and I did hit multiple profit targets in this week, where again, I take a portion of my profits off, lock those away, market can't take that away from me, and I also reduce my position size, which at the beginning of the podcast I talked about is very, very helpful because there's less stress and it makes it more likely that you're going to follow the process that you laid out at the beginning. This particular week started off again very, very strong and took another profit target very near the high. So this particular trade on the weekly has done very, very well from entry price to current price with the remaining shares up 13.59%. Now, I do want to point out earnings are coming up. Looks like it says here on April 30th. I don't hold through earnings. So regardless of where this is, if it's, of course, if it closes below my stop, I'm going to get out. But even if it's zooming higher and nothing about my strategies told me to get out, I will get out regardless of where this is, as long as I'm in the trade before the day before earnings on 4:30, because I don't hold through earnings. So this trade doing very, very well. Remaining shares up 13.59%. And then last but not least today, Lockheed Martin. Okay, Lockheed Martin is, I was telling you about fair value gaps. I was telling you about order blocks. This is exactly that particular trade. Well, this particular bar back here, and these are a little bit more difficult. This is an order block. This is your highest high before a break in structure. And let's talk about structure again. Here we have a high. Here we have a higher high. And then this huge bar down here goes below the first swing low to the left. That changes market structure to the downside. Now it becomes bearish. And again, my principle is once you change market structure from bullish to bearish, you want to short rallies. If it was the opposite, and I'll show you some when we're looking at the trades I'm looking for next week, bullish ones, if you change market structure from bearish to bullish, then you want to buy a dip. If you change market structure from bullish to bearish, then you want to sell the rip or sell the rally. And so the proper place when you change market structure, if you have an order block here at the top, is anywhere from the bottom of the order block to the top of the order block. So we broke market structure down. We did rally back into the order block. I got short here for 456.30. My end of day stop is simply going to be a close above this high, and because if it does that, then it changes the market structure back to bullish. And then, as always, I have my 2 ATR emergency stop above. Make sense? All right. So I did get short here for 56.30. The next week, it did go down enough for me to take a partial profit off. I took 10% of my position off, reduced it down to 90%. Last week, or this week, we went down very, very strongly, and I took off another 20% of the remaining shares, because you can see at the low here, we did go down enough for me to take 2 profit targets off. So again, when the market gives me something, I always take it, And my level of what I need is if it moves the value of 0.45 ATRs. Right now, it's the value of 0.45 ATRs is 537, which all that means now we closed at 450.40. If it moves down on Monday, $5.37, I'm going to take another profit target off. I'm going to take another 10% of the remaining shares that I have, right? And then if it gets to my trailing stop level, then I go into trailing stop mode. So I know what to do, right? If it moves the value of 0.45 ATR, I'm going to take some off. If it gets to my trailing stop level, then I'm going to go into trailing stop mode. If it closes above the top of the order block, I'm simply going to get out at the end of the day. If it gets to my 2 ATR emergency stop, I'm simply going to get out. So it's a nice, gentle, holistic way to trade, rule-based way to trade. I know exactly what to do. I don't have to, have an opinion on this or forecast anything. I just know what to do depending on what the stock on that particular market does, right? And this is what I would teach you in our private one-on-one lessons. And it will change your trading and make trading much less stressful on you. And then again, earnings here on the 23rd of April, regardless of where it is, as long as I'm still in the trade, I will exit the trade. So this particular trade, doing pretty good. Remaining shares on the short up 1.34%. So just real quick recap on the weeklies. Closed XLF for a gain of 23.23%. CCJ open trade up 13.59%. LMT short up 1.34%. All right. So those are our current trades. It worked out pretty good this week, and I am grateful for that. Okay, so before we start looking at next week's trades, next week's potential setups, I do want to talk a little bit about trader psychology. This is from my good friend Stephen Goldstein. You can follow Stephen at AlphaMind101 over on Twitter. It's a great channel. He's a retired professional trader and a world-class trading coach from the psychology portion of trading. He has a great podcast where he interviews traders from all over the world, all levels, from hedge fund managers, large financial institutions, prop firms, and down to retail traders like me. And I was fortunate enough to be interviewed on his podcast 2 times. So it's a great channel, great podcast. Check it out over at AlphaMind 101. So let's see what Stephen has to say here. I read this and immediately I was like, oh, I'm going to talk about that on the podcast because this is good stuff. I'm never ever going to apologize for over posting this Victor Sperandio. Sorry, I don't think I'm saying that right, but posting this Victor quote from Market Wizards. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. Isn't that something? The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. Why are more people why are more people not making money in trading? I'll tell you, because they don't have a process. And maybe they do have a process and they're not following it. It comes down to emotional discipline to follow your process. Again, that's why I'm talking about phasing out playing offense in your trading helps you in many, many ways to strengthen your emotional discipline that you can follow your process. If intelligence were the key, there would be a lot more people making money. There are a lot of smart people out there that lose money trading. And why? I'll tell you why. Because they have opinions on the market. This is too high, it's not going to go higher. This is too low, it's not going to go lower. They front run their signals because they're smart. They can see something forming, but that doesn't usually work so much because the market can go much lower than you think. It can go much higher than you think. People said, who would be your best trading candidate? And I've said this for years. Give me a 18, 19-year-old kid that just got out of boot camp from the Marines, that follows orders, that doesn't overthink things, right? I would take that over someone for Harvard or Yale all the time because they're going to think to themselves, oh, I know better than the market. I'm going to do my own thing, where probably that kid out of boot camp is going to listen to me and take orders. And I'm going to say, look, if it's over this line, stay in. If it's under this line, get out. It's about that simple. Stay in over, get out under. I say that to someone from Harvard or Yale that has degrees in an economy, they're not going to do it as much because they're going to think they know better than the market. We don't know better than the market. Just follow the rules in the market and of your trading approach with a good risk to reward ratio, and don't overthink things. That's really what it comes down to. So yes, I don't want the smartest guy in the room to be my trader. I want somebody that knows I'm in over this line, I'm out under this line. I don't care what the news is. I don't care what my economic forecasts are. Look, I've run into this in my trading career. I like economics. I follow economics a lot. It was one of my best subjects in school. But I can tell you that my predictions, although generally right in the long term, not so right in the short term. Usually I'm early. And I have found that just letting the market technicals guide you is much, much better than trying to forecast. That trade on XLF that I was in for over a year, there was nothing about taking that long trade in the news or anything else. If you went back to that time, it was doom and gloom, everyone. Why did I take the trade? Why did I buck the trend? Why did I not listen to the noise? Because my indicators told me to. And your indicators are going to be much more accurate than your opinions. You may be right. A lot of smart people are right, but they're often early. And that's one of the challenges I deal with myself. And so I'm talking from experience. So I'm never, ever going to apologize for overposting this post from Victor. Quote, in Market Wizards, the key to trading success is emotional discipline. Or in other words, following your rules, following your process. If intelligence were the key, there would be a lot more people making money. That's it. So thank you very much, Steve. Appreciate that. Really, really great post. And please follow Steve at AlphaMind101 over on Twitter. All right, let's get to my trades that I'm looking for next week. Now, I do want to point out, everyone, that here on the daily charts, these are the potential dailies, I have 9 symbols. Does this mean that, theoretically, Monday, for instance, all 9 of these could trigger? Does that mean I would take all 9 signals? No. Even if all 9 signals, I would narrow it down to only the best one. How do I do that? Well, I look at many things. How many confluences and entry triggers happen at the same time? The more, the better. Which one has the best risk to reward ratio? Which one looks best on multiple time frames? Which one had the best relative strength of the market that day? Which one, long-term, looking at fair value gaps, looking at order blocks, lines up with the signal that I'm looking for? Right. I mean, that kind of comes back to the first one that I was talking about, confluences, multiple confluences and combinations of indicators. But I'll highlight this as we go through, because the reason I mentioned that is there's quite a few. As a matter of fact, I was speaking with, like I mentioned, I was speaking with one of my students, Andy, last week, and I had him show me his trades, and he took a trade that wasn't working out, and I said, I would not have taken that trade. As a matter of fact, I probably would have been short. And he said, why? And he said, because that was a legitimate signal. I said, yes, it was a legitimate signal, but if you look at it big picture, it was inside a bearish fair value gap or order block. I can't remember what it is, and that would make me more inclined to short it, and it did go down. Okay, so keep that in mind. You have to narrow down to the very best signal, and you have to look at many, many things. And that is what I will help you learn in my one-on-one course, is to how to get out your fine-tooth comb and narrow down what is the best trade if you have multiple candidates. Okay, so let's look at Apple. Apple bucked the trend the last couple days and went up, which was very impressive considering that the market was down so much. This is very interesting on Apple. And I've been talking about changing market structure. This changed market structure to the upside Okay, if something changes market structure to the upside, what do I want to do? I want to buy dips. If something changes market structure to the downside, I want to sell rallies or sell rips, right? So let's take a look at this. Apple, here we have a low. Here we go below the low, right? Pretty simple. We have a low, we go below the low. That's the first requirement. When that happens, I look to the left and I look for my first swing high. Here's a high with a lower high to the left, a lower high to the right. If I emphatically go above that pivot point of that swing high, then I change market structure to the upside. Well, on Thursday, we clearly did that. Then I need one more bar to give me my third bar so I can find out where the fair value gap is. Here's bar 1, here's bar 2, here's bar 3. Did we change market structure? We certainly did. So I go from the low of bar 3 to the high of bar 1. This is a big fair value gap here in the blue. Now, how to enter this trade? Theoretically, even if I came down to here, the top of the fair value gap, I could get long. I don't think I'm going to do that because my stop on this is your most recent swing low. Well, there's a lot of range there, too much range for me. So what I'm looking for is here at about 170, 150. And why do I pick this point? Because it's halfway of this big bar. We have a low, we have a high. Halfway of big upward bars from a Fibonacci standpoint would provide some inherent support here at 170, 150. I'd rather buy it at 170, 150 and have my stop down here, 167.23. Ideally, to come and close the gap here at 170.10, that would be the best because it would be a lower price. And again, it would be much closer to my stop. And the closer I can get to my stop, the more likely, if I'm wrong, the smallest amount. This is also an order block. Here's the lowest low before a market structure change. So I feel like Apple is going to be bullish here. I'm just waiting for a pullback, and I can't say exactly where I'm going to get into this trade, but the levels, I'm not going to buy up here. It may just pop its head down here and then take off, and I'm going to miss it. That's okay. But for me, the levels that I'm looking at would be about 170, 150 here in the values, or here halfway. Or if we have a big move down, which honestly, that would be great because I'd like to buy it as low as possible because this market structure change to the upside is dramatic. I would be very surprised if we go down and make new lows from here. But again, it's a little stretch and overextended here. So I have to be patient. I would like to get into this trade. So for me, selling puts down to 170, 150 or selling puts to 170 would also be an option for me too, because I don't think they're going to get down here. I could be wrong, right? I'm often wrong, but I really don't think so with this huge change in market structure. So just to reiterate, for me, I am looking potentially for the market to go down to 170, 150. I would consider buying there. If it got down to 170, 110, I would definitely be even more happy to buy there. Or even back here, the top of the order block at 169.10 would be an amazing area to buy with a great risk to reward ratio, but I don't think that is going to happen. So what I'd really like to see this do is come down into the value zone, have some sideways motion, and then have a V1 or a V2. So a V1 or a V2 inside the fair value gap with this market structure change to the upside, that would be the dream trade. But I don't know if it's going to get there. And again, it might just take off and I'll miss it and boo-hoo, right? So anyway, somewhere here between 170, 150 and 169.10, that's a good way to put it. These are the areas that I would be looking for. Unless we come down, go sideways, and I have a V1 in here, that would also be a little bit. So I know this trade is really open-ended here, but it's just one of those trades where lots of different things could happen. But big picture here, I think Apple has made its short-term lows definitely on this market structure change. The Dow. All right, DIA. Well, this is the Dow Jones Industrial. This has been the worst performing index out of the major three. We have really, really broken down. If you remember, I've been watching the channel for a while. I've really been warning that I thought we were near a high because of negative divergences and other things. But the DIA has really taken it on the chin. We broke down, we broke these levels, we broke these levels. But it does give some potentials here for some potential buys. Right now we're at a 33.84. And remember, this is an index, okay? In 30 RSIs on index, in my experience, tend to work more than they do on stocks. And so a 30 RSI on any major index is a very interesting level for me. We're also, actually, we're below the negative third ATR channel. The negative third ATR channel is a very strong level generally. About 92% of the time when you get to the negative third ATR, you're going to stop going down or go up. We are underneath it, which is a little bit of a concern, but we're at a 33.84. If we next week reject the 30 RSI, I would consider getting long the Dow. Why? Well, you see the two lines I have drawn here? Well, they're for a reason. If you go back in time, see this fair value gap? We have a low, we go lower, we go above. This is a fair value gap. This is a level just by itself. This is a level just by itself. Well, if we go down, this level, this area here is going to dovetail with the 30 RSI. So again, you have multiple confluences of signals. You're in a fair value gap from the past, which by itself is good. And then if you can reject the 30 RSI as well, that is also good. Okay, so to make this simple, I am looking for a rejection of the 30 RSI, either an intraday under 30 over 30 or a close under and close over 30. But those are the signals, rejection of the 30 RSI, and what sweetens the deal is that rejection of the 30 RSI would happen right here in the fair value gap. Home Depot. Okay, Home Depot is very, very low at this point. And what I am looking for is a potential. There's two ways I'm approaching this. We're at a 29.94. We could go back over the 30 RSI. That would be a legitimate entry signal because looking back in the past, you see the high of the order or the fair value gap and the low of the fair value gap. This is a level of support. And look right here. We got there and headed right back up. Well, now we are back, but now we are back here at a under 30 RSI. I don't want to take it under 30 RSI. I'll just have to see what happens on Monday. If we rally, I will definitely consider, it will still give me a good risk to reward ratio. Let's just say it closes at 31 RSI. Well, then my stop is simply a close under the 30 RSI. So potential on Home Depot, which has really, really gotten beat up next week, would be a possible gentle close over the 30 RSI. That is one potential. Or another potential would be if we continue down the 200-day moving average, the black line here. Ideally, I'd rather buy there because it's lower and it gives me a very, very definitive risk to reward. Stay in over the 200, get out under. But Home Depot has really, really sold off dramatically. I would expect a bounce, but you never know, right? Markets can go lower than you think. But right now we are in a fair value gap to the left and we are under 30 RSI. So potential close over 30 RSI. I may take the trade. Don't know. I don't know. It may do that, but I may one of these other symbols that I'm looking at may have a better score, might have a better quality score, right? More confluences. But a rejection, a close back over the 30 RSI, I would consider if we head lower, a rejection of the 200 would also be an interesting spot. IBB, NASDAQ Biotechnology. Okay. Well, we are coming to some important levels here. Look, we've got the 200-day moving average. We've got the 250-day moving average. We have the 300-day moving average. A lot of major moving averages here that should provide some good support. We're in the low 30 RSIs. Okay, this is a straight up deep dip buy approach. And by the way, if you like these deep dip buys, and I do a lot of these deep dip buys. I teach them in my private one-on-one lessons, obviously. But another option is I do have a great course on udemy.com. I have the link in the description of this video. It's very, very affordable. It's a 9.5-hour course, and in that very affordable course, I teach you step by step all the rules for the deep dip buys. It's a great way to start to trade. I've sold so many of those all over the world. I think I have like 4.8 stars on that particular course. So consider that. Consider that if you like these deep dip buys. And in that course, you'll see me talking exactly about situations like this. So we have the 250, we have the 200, we have the 300 RSI. You can see there is a fair value gap way back here, and that's exactly to the penny where the market rejected it on Friday of 128.94. It did touch that, but the key is that not only is in the fair value gap from the past, it's also very close to the major moving averages. So it didn't get down to the 200-day moving average. I'll see what happens on Monday, but if we do reject the 200-day moving average or the 250 or the 300, it already did that on, but I'd really like to see it reject the 200 because it's further into the value gap from the past. I think that would be a decent area to potentially consider for myself to take this trade, but we'll have to see what happens. But we're at these levels: major moving averages, negative third ATR channel, low 30 RSIs, and a fair value gap. So I think that offers some opportunity there. So that's why it's one of my candidates. I'll just have to see what happens. Altria Group. Okay, Altria Group. You've heard me talk about this in the past. Something I've noticed over many, many years is when you get a golden cross is when the 50-day moving average crosses over the 200-day moving average. When this happens, something I have noticed is the first bounce at the 200-day moving average after the crossover happens is an excellent place to buy. I on this podcast, I took that trade on Disney. Same thing happened. The 50-day moving average moved over the 200. The market came back to the 200 and then took off to the moon. The golden cross is a very bullish signal, but what I've noticed is as soon as you get a golden cross, you usually come down first, which is counterintuitive, but that's usually what happens. But because the 50 crossed the 200, a rejection of the 200 just by itself is a decent setup. But I like to look for those confluences of setups, and the 50 crossing the 200 prior to the rejection of the 200 makes this trade even stronger. So what I'm looking for next week on MO potentially is a bounce at the 200. And in addition to that, that 200-day moving average does line up with some previous resistance that we broke through. And if you break through resistance, that level, instead of becoming resistance, becomes support. So if you just draw this line out here, that support coincides with the 200-day moving average and also coincides with the 50 crossing the 200. So I am looking for potential entry on Altria Group MO here at the 200-day moving average. Merck. Okay, you saw me highlight on CCJ a return to value V1, V2. Well, look, it's exactly what's happening. Remember the green line, the top of the green line, the bottom of the green line. This is the top of the value zone. This is the bottom of the value zone. I don't like to buy overvalue. People that bought up here, not very happy with their investment. But we were above the value zone. We have come back down into the value zone. So remember the first rule, close above the value zone, check. Second rule, come into the value zone, check. Third, sideways motion. Do we have sideways motion? Check. Now, how do I enter the trade? I enter the trade with potential V1 or V2. So I still need a V1 or V2 to get into this trade. V1, potentially on Monday, we go lower, take out bar one's low, close above. That would be a V1. Or Monday we go down, wash bar one's out. Next day we go up, form close above bar one's close. That would be a V2. So the setup here is perfect. Close above the value zone, come into the value zone, sideways motion. Checks all those boxes. That's it. But I still need the trigger of a V1 or a V2. Nike. Okay. Really like this trade, everyone. I really do. We talked about Apple and the change in market structure. Same thing here. We have a low. We run the low. Thursday, we took out this swing high. What does that do? That changes market structure to the upside. So what do I want to do? I want to, now that we've changed market structure to the upside, like to come back by that dip. And where's the dip? The dip is inside the fair value gap. Bar 1, bar 2, bar 3. Oh, sorry. Actually drew that wrong. My apologies. Yeah. Fair value gap is a little bit larger. There we go. There's the fair value gap. Bar 1, bar 2, bar 3. Oh no, I did it right in the first place. I'm sorry. Okay. No. Greg. Okay, there we go. So anywhere here in this fair value gap, oh, I had it right in the first place. There we go. All right. Anywhere from 91.10 down to 91.10 to 90.10, that is the fair value gap. If we pull back into this area, that would be a really good spot. Ideally, the bottom of bar 1 is also an order block. The top of that order block will become the support. But anywhere really here from 91.10 down to 90.10 within this dollar, this pullback would be a legitimate entry. My stop would be a close below this low. If it made a new low, it would change the market structure to the downside. But at this point, Nike's big international company. They've been very, very weak, but there have been some signs here of a move to the upside. And in the move to the upside, I want to buy those dips. So I really like this setup a lot, and I'll just have to see what happens. My ideal would be 90.10 because that would be the top of the order block. But I like this trade very, very much. Shopify, S-H-O-P. Okay, well, don't usually look at Shopify too much. Really has gotten beaten down here. But the levels that I'm looking for, it's getting to these levels, right? We're at the negative third ATR channel. We're near a 30 RSI. We're near the 200-day moving average. What I really like on Shopify, but I have to be very, very patient. I don't think I'm going to fool around with it at the 200 and the 30 RSI. If I go back in time, I see this fair value gap from 65.80 to 63.40. Now, it's still a ways down there, but I wouldn't be surprised if the market does get there. But if you take this fair value gap and you run it out into time, you see how that lines up at the 250-day moving average. So I'm not going to mess with Shopify personally unless we go down and reject that 250-day moving average, or if we go even lower to the 300-day moving average. It may not get there. It may just take off from here and I miss the trade, but that's fine. But for me, again, being patient, identifying the levels that really make sense. What levels really make sense? The 250-day moving average. Why? Because in the past, we fell into this fair value gap, which adds bonus points to the trade. So very simply, I'll consider Shopify, but only next week if we reject the 250-day moving average or the 300-day moving average. Last but not least on the dailies is Unity Software. Okay, you've heard me talk about return to value V1s, V2s. That is one strategy that I teach in my private lessons. But I also teach another strategy with V1s, V2s called a higher low V1, V2. V2. And this is setting up and formatting perfectly for that. First rule on a higher low V1, V2, you must close below the value zone. We closed below the value zone. You must rally into the value zone. We did rally into the value zone. Then you have to pull back. We have pulled back. So this trade for me potentially is only Monday only, if we close above 2610, then that would be a V2. Bar 1, bar 2. Bar 2 goes below or washes out, bar 1's low. The trigger would be Monday only if we close above bar 1's closes, 2610. That would be a higher low V2 entry. If it happens, my stop would be a close below halfway of the washout bar. Of course, I place my 2 ATR stop below. We do have what's called the double bottom bullish divergence. Here we have a low. See the lows? We have the deep red MACD bars. Well, now we've come down here, tested these lows. There are no red MACD bars. This is called a double bottom with a bullish MACD divergence. I studied one-on-one with Dr. Alexander Elder. This is what I learned from him. He feels like this is one of the strongest technical strategies in trading, and these work really, really well. So if this does trigger on Monday with a higher low V2, the double bottom bullish divergence adds bonus points to that trade. If we come down lower and we go reject the 30 RSI, I would consider taking that as well, because an under 30 over 30 with a double bottom bullish divergence is better than just a plain under 30 over 30. It's much better. So if it goes up on Monday over 2610, I could consider getting into that trade. Or if it goes lower, I would also consider getting into the trade with a rejection of the 30 RSI. All right, so those are the dailies. A lot of good potentials. Again, it's going to be, a bit of a chore if they all trigger which one to pick. But again, it comes down to which one has as many potential combinations and confluences of signals and entry triggers happening at the same time, which one has the best risk to reward ratio on that particular day, which one looks best on multiple time frames, and which one had the best relative strength compared to the rest of the market. All right? Again, this is what I teach in my lessons, how to do this, how to get the fine-tooth comb and narrow it down to the best candidate of the day. All right, let's go to the weeklies. I don't have a lot on the weeklies. I think I only have 3. Adobe. Okay, Adobe, there's 2 potentials here. We did close under the 200-day moving average. We're at a 3687 RSI. We are getting close to the negative third ATR channel. A potential close above the 200 next week and a V2 would be a good signal with a good risk to reward ratio. Ideally, I'd rather try to get Adobe if it comes down and tests this 250-week moving average. Again, this would be a deep dip buy approach, and the RSI would be lower. It could potentially be a rejection of the 30 RSI and a rejection of the 250-day moving average. If that happens, there's a good chance that would be the low in Adobe. And you can see Adobe on the weekly has really come down. It's probably due for a bounce, but that would be my ideal location. A rejection of the 250-week moving average, and cherry on top would be a rejection of the 30 RSI. Let's go to the Russell 2000. Okay, well, Russell 2000, of course, took it down 2.81%. I'm simply looking here at the 200-day moving average. Also would come inside a fair value gap between here, and that 200 sits right inside that fair value gap of 196.10 to 188.10. So big range there, but the key would be the 200. Look to the left. Did it respect the 200 last time? It certainly did. Touched it, buyers came in, and it went up. So I'm simply looking for potential to get long IWM on the 200. This, of course, will have a lot to do with interest rates, and I'll go over a little bit with the market and bonds when I'm finished on the weekly. So IWM, some kind of rejection of the 200-day moving average. And last but not least, on the weekly, UNG. UNG is natural gas. Well, natural gas has gone very, very, very low. But what is gaining some attention here for me is that we have this sideways motion here, and we're at a 3461 RSI. If and only if next week we have a rejection of the 30 RSI, I would consider getting long UNG, but we're still quite a ways from that, so I don't know if that's going to happen. So, all right, so I hope that was helpful. If it was, please hit the thumbs up button. Really would help out the channel. Now let's take a look at the indexes in general and get an idea. Okay, here are the cues. If you've been following my channel over the past month, I said I'm very concerned about the cues going down here because we keep going higher and higher and higher and higher. Positive MACD goes lower and lower and non-existent. All that meant is we're running out of buyers, and if you run out of buyers, the implication is you are going to go down. Well, the cues have held up better than most. It's been extremely choppy. We're up, we're down, we're up, we're down, we're up. Very difficult to trade this here. So in order to get long the cues or for the cues to go back up, I'm not messing with it even if we have a rally. This area up here, buyers have refused to make this go any higher. I would need some more sideways motion here on the cues, and then a V1 or a V2, or a move back down, ideally down the negative third ATR channel. So if we are consolidating. Consolidation leads to trends one way or the other, but in my opinion, in my experience, I think we're going to be heading lower rather than higher. You look at the SPY, again, we have all these higher highs, higher highs, higher highs, MACD, less, non-existent, and now the SPY has broken down. So I feel like there's some more downside there as well. We talked about the diamonds. Well, the diamonds is about the only index, again, because I just went over it on the potential daily trades, that we come down into this fair value gap from the past, from 377.80 to 375, and that would also coincide with the 30 RSI. But really what I want to show you, and really what this is going to come down to, are bonds. Everything is going to be, I mean, it's driven by some geopolitical things and Middle East tensions for sure, but ultimately the market's going to be, it's going to follow the lead of bonds. And we had some high inflationary economic reports last week. This has moved bond prices down, bond prices go down, yields go up, and this is what has been a big weight on the market. However, I took that bond trade. I was wrong on the bond trade, but we did have a V2 on Friday. We had bar 1, bar 2. Bar 2 went below bar 1's low and closed above bar 1's close. That is a bit of a good sign. We went under the negative third ATR channel, over the negative third ATR channel. That is a decent sign. You can see it's a V2. I wouldn't be surprised if bonds come down here, test halfway of this. But if bonds can get a bid, then that will help the rest of the market. So really watch the bond market. It's probably going to dictate where the stock market is going. And especially on that potential diamond trade, the DIA trade, if bonds can start to go up now, make a trough and start to go up, you're probably going to see the markets rally a little bit too. So, please be careful with all this, but really, really watch bonds. VIX, VIX has been dormant for so long, but look, VIX has really, really broken out. VIX is in a bullish market structure now. We've taken out swing highs to the left, and it is going higher. Why? Because volatility is back in the market, because of the inflation, because of the potential Middle East tension. So, you're going to need to see VIX come down as well in order for the markets to really rally. But Friday was a big move down. Thursday we had the big move up, followed by a huge move down on Friday that just got everyone, and VIX responded. So VIX being higher here, that's a warning sign for the market. So please be very, very careful. You're going to want to see VIX completely reverse. That's probably tell you that things are more conducive for the market to come up. So I'm watching bonds very carefully, and I'm watching VIX very carefully. So I hope that is helpful. And throughout the podcast, I've talked a little bit about my my one-on-one course. I have a great course, everyone, that I teach one-on-one. I think taking a course one-on-one is the best way to learn anything, whether it's trading or guitar or ice skating or whatever, tennis, right? But the course I have is 15 hours. Each session is 3 hours. So it's a serious, we spend a lot of time together, 3 hours at a time, and 5 times. We usually do it once a week. I teach you all of my different trading approaches. I teach you step by step. Once I teach you the lesson, then I let you drive. We go through and do all sorts of simulations on random time frames, random markets, and you're the one telling me, okay, Greg, we're in, we're out. And I'll say, yes, you're right, or no, you're not right, and I'll explain why. But I don't just teach you. We go through and do simulation after simulation after simulation after simulation. I really want to make sure that you know the rules, and I won't let you go until I know that you have learned all of these strategies. It's going to make you a better trader. The cost is $1,750, but it's worth every penny, I promise you, for the content you get and the one-on-one instruction you get. So if you're interested, send me an email, and we'll get we'll start the process. Usually I like to have an initial Skype call with a prospective student. I like to learn more about them, what their goals are, what their challenges are. And then it's a good time for them to ask me any questions, specific questions they have about the course. And when we're done with the call, that's it. Then after the call, it's up to you. If you're interested, you just get back with me. And if you do get back with me, we'll schedule it. And I promise you're going to enjoy it. I also talked about my online course, the Deep Dip Buy Stock Trading course on udemy.com. It's super affordable. It's somewhere between $14 and $40, depending on the day, but you get so much for the money. So consider that. The link's in the description. Again, if you like the podcast, all I'd ask for is that you hit the thumbs up button. It really helps out the channel. And most importantly, everyone, please try to go out and do something nice for someone today. It's, the world would be a better place if we could do one nice thing for another human being each day. It would be even better if we could go out and do one nice thing for an animal each day. Animals appreciate acts of kindness just like we do. So, why not be the one that does a nice thing, and one day it will be returned to you as well. So that's all I've got for this week. Please be safe. Market volatility has returned, so please follow your process. Be careful, position size correctly, and God willing, I'll be back next weekend, and we'll see what's happening. But I really appreciate you being here. I hope you have a really good weekend, and hopefully I'll talk to you next week. Thanks so much, and on the way out, I have to run the U.S. legal disclaimer. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.